So in the last episode, we alluded to the fact that there may be times when you don't include income in a certain year, but that it might be included at another time period. And that's what we're going to talk about in this episode, the year of inclusion. We're going to talk about the different accounting methods, including the cash method of accounting, the accrual method of accounting, and the hybrid method of accounting. So first off, it's important to define what a tax year is. So for individuals, a tax year is typically on a calendar year basis. So a year starts on January 1st and ends on December 31st, but an individual can elect a fiscal year if they have a good reason for doing so. There are restrictions applied to S-corps and partnerships and personal service corporations as to whether they must claim a calendar year or they can elect a fiscal year. But in determining a person's tax liability, it's important that the income be placed in the correct tax year. And the idea here is that you must do it according to what sort of accounting method you use, because the taxing authorities do not want you to try and shift income into periods where there is a lower, so if you make more money in 2017 than you do in 2016, they don't want you to shift that, some of that money to 2016 to get a better tax rate. So let's talk about the methods of accounting. There are three methods of accounting. Primarily, there is the cash receipts and disbursement method, which is also called the cash method of accounting, the accrual method, and there is a hybrid method. The IRS has the power to prescribe the accounting method to be used by the taxpayer. They want to make sure that they're paid the proper amount of tax. And so in order to satisfy the bookkeeping requirement, the IRS requires a taxpayer to reflect all adjustments on its permanent books and records or on permanent supplementary records. Permanent records include records that are prepared in the ordinary course of business, that are sufficiently complete and accurate to provide a reliable and accessible basis for computing tax, and are retained as long as the contents may be relevant for income tax purposes. This is according to Revenue Ruling 58601. Internal Revenue Code Section 446A provides that taxable income shall be computed under the method of accounting on the basis of which a taxpayer regularly computes his income in keeping his books. And when defining the method of accounting, this includes not only the overall method of accounting of the taxpayer, but also the accounting treatment of any specific item, including depreciation. And then to wrap everything up, not only did the IRS rule in a revenue ruling and the Congress rule in Code Section 446, but the tax court has held that the IRS's failure to challenge a taxpayer's accounting practices over a period of years or its acceptance of returns based on an accounting method that does not clearly reflect income will not preclude the IRS from later challenging the use of that method. This being from a case where after 23 years of accounting for the sale of gems and paying tax according to how they believed it should be done, the IRS came back and said, no, for 23 years you've been doing your taxes not consistently with your books, your accounting books. Therefore, you have to we get to undo all of your tax returns through an audit, and you're probably going to have to pay more in tax. This is huge. You must do so. A lot of accountants think that it's okay to do otherwise, but it's not. And it has been found by both the IRS, Congress, and the courts that you have to do your taxes according to your books. So what are these accounting methods? The first is the cash method. This is where income and deductions are taken in the year you received your income or you paid your expenses. Cash, property, or services received are included in income in the year of actual or constructive receipt. It doesn't matter whether or not it's earned yet, but whether or not you were paid. So for example, an attorney who receives funds for services that they are going to perform would have to pay tax on the funds that they received, even if they haven't yet completed the task. Property received is valued at its fair market value. Notes, such as an IOU that has legal standing, are also considered income. But a promise to pay, such as accounts receivable, is not enough because you have not received the payment yet and you don't have that legal standing. So when you receive a check, it is considered income unless the payer asks you not to cash it yet because he doesn't have the money in the account. Now there is an exception to this rule. The exception is constructive receipt. Income that has not actually been received by a taxpayer is taxed as though it had been received under the following conditions. So the amount must be readily available to the taxpayer. The taxpayer may alter this though through contract, and there is no substantial restriction. Now this is a factual inquiry. What this means is that, let's say that a lawyer has performed services, but he calls up his client and he says, hey, would you mind paying me not this year, not 2016, but in 2017? And the client's like, well, I can pay you right now. And the attorney says, no, I want you to wait until 2017. I made too much money this year. This is considered constructive receipt. You could have received the funds, but you didn't. Another way of considering this is you receive a check, but you don't cash the check. You received the check, therefore it is considered constructive receipt, even though the funds had not yet been put into your account at the end of the year. The rationale behind this is that if the income is available, the taxpayer should not be allowed to postpone the income recognition and should have to pay that tax. So let's go through an example. Steve is a member of a barter club. In 2016, Steve performed services for other club members and earned 100 points. Each point entitles him to $1 in goods and services sold by other members of the club. The points also can be used at any time. So in 2017, Steve exchanged his points for a new high-definition TV. So when does Steve have to recognize income and be taxed on that? In 2016 or in 2017? Well, since the $100 per point was earned in 2016, he has to recognize the income in 2016, not in 2017 when he used them, because they were readily available. So what about point credit cards? If you receive points because you used your credit card, does that mean that you then should be taxed on the value of those points? And the answer is yes. You should be reporting those points, the value of those points that you receive on your credit card. It's not just free cash. Nothing in this world is free when it comes to the IRS unless Congress has stated otherwise. So now let's go to another example. Jana has a savings account with Rocky Mountain Community Credit Union. Under the terms of the account, interest accrues monthly and the depositor can withdraw the funds, including accrued interest, at any time. So now the question is the interest something that she is taxed on in the year that it accrues? Well, yeah. The interest is constructively received in the year that she can then withdraw them. On the other hand, this is not the case when it comes to life insurance and the cash surrender value of life insurance. The annual increases in the cash surrender value of a life insurance policy are not taxable income as long as the policy is not surrendered. So in technical terms, there is no constructive receipt of income with the cash surrender value, even though the policy owner has the right to withdraw the cash value at any time. And this is because the constructive receipt doctrine does not reach income the taxpayer is not entitled to receive, even though the taxpayer could have contracted to receive the income at an earlier date. It all has to do with contracts. It all has to do with what the terms of the agreement are. If there is some sort of a limitation, then it's not constructively received. Now, there is another exception called original issue discount. This is when you receive payment at maturity more than the amount of a loan. And that difference is original issue discount. So interest must be reported when it is earned, not received. There is no restriction here when you are earning that interest. Interest earned is calculated by the effective interest method. So for example, a taxpayer who bought a CD for $8,573.39, which pays $10,000 2 years from when he buys it, with an effective interest rate of 8%. Each of the 2 consecutive years are as follows. In year 1, what we do is we take the amount that he paid for his CD and we multiply that by the 8% interest rate. That leaves him with $685.87. This is his interest for year 1. Now in year 2, we then take the amount that he paid for plus the interest that he received. We add that together and we multiply this by the 8% interest. This is because the new basis in his CD is now considered the sum of $8,573.39 plus $685.87, and that gives him taxable interest for year 2 of $740.74. That is the interest which he has to pay tax on in each year. So then, when he receives the $10,000, this $10,000 is the sum of the $8,573.39 plus the $685.87 and the $740.74. Because he has already been taxed on this income, he doesn't have to pay tax on it again, as it is a return on his investment. Okay. Now this concept of original issue discount does not apply to amounts due less than 1 year from the date of issue. So you take out a CD and it has a 10-month period, well, the original issue discount does not apply here. For U.S. savings bonds, Series E and EE bonds, and EE bonds, the difference between the purchase price and the amount received on redemption is treated as interest income from the investment. The income from these savings bonds is generally deferred until the bonds are redeemed or mature. But there is an annual election that you can do to include in gross income the annual increment in redemption value. This election applies to all bonds, all such bonds, and subsequently acquired securities on an annual basis. To change the method of reporting this type of income from bonds requires permission from the IRS. Additionally, tax-free bonds must amortize the premium. However, taxable bonds may amortize the premium. So now let's go on to the accrual method of accounting. Income is included when earned, not when received. So how is the accrual method different from the cash method of accounting? Well, when you're doing it based off an accrual method, income is included only when it's earned, not when it's received. Totally different set of circumstances now. So all the events have to occur fixing the right to receive the income, and the amount can be determined. This gives rise to the claim of right doctrine. This doctrine applies only when the right to income is contested. So typically, income is included when it's received. So a deduction is taken if it must be repaid. For example, a contractor performs construction services and a homeowner refuses to pay, claiming that the contractor has not met specifications. And let's assume that the contractor did not reach a settlement until the following year. With this set of circumstances, the contractor includes the income in the following year. But had the homeowner paid for the work and then filed suit for the damages, the contractor would have had to include income in the current tax period and then take a deduction if repayment to the homeowner is required through the courts. Now, what about prepayments? Taxpayers have repeatedly argued that deferral of income until it is actually earned properly matches revenue and expenses. Additionally, a proper matching of income with expenses of earning the income is necessary to clearly reflect income as is required by the code. So, the Treasury Department came up with the Internal Revenue Code section 446B, which grants that broad powers to determine whether an accounting method clearly reflects income. So this is interesting because what this states is that the method of accounting, the way that you account for certain types of income, you have a little bit of flexibility. But the IRS will come back, and if it's not clearly reflecting income, they can undo the way that you have done your accounting to clearly reflect income for tax purposes. Also, the IRS has stated that GAAP, generally accepted accounting principles, do not dictate tax accounting for prepaid income because of the practical problems of collecting federal revenues. And these practical problems are that generally accepted accounting principles want to reflect income in a way that it doesn't harm potential investors, and so they state that it's better to underestimate income rather than overestimate income for protecting investors. However, the IRS wants to be paid, the government wants to be paid, and so if you're underestimating your income to protect your investors, you're not paying the tax that is properly owed. However, there are two exceptions that have been created by the IRS. The first exception is a deferral of prepayments for goods. This is allowed if the accounting method is the same for accounting and tax. So for example, Blue Company will ship goods only after payment for the goods has been received. In December 2016, Blue received $10,000 for goods that were not shipped until January 2017. So the question becomes, when must Blue report the income for tax purposes? Well, the income must be reported in 2016 for tax purposes, assuming that even though the company, and this is an assumption, reports the income in 2017 for financial reporting purposes. The second exception for prepayments is the deferral of prepayments for services. Revenue Procedure 2004-34 permits an accrual basis taxpayer to defer recognition of income for advance payments for services to be performed after the end of the tax year of receipt. Partial inclusion is necessary for partial services provided in the year of receipt, with the remaining income included in the subsequent year when services are performed in the subsequent year. The method may be used for advance prepayments received for goods, intellectual property, the sale, lease, or license of software as well. This does not apply to prepayments for rent or prepaid interest. Prepaid rent or interest is always included in the year of prepayment. However, no deferral is allowed if the taxpayer might and chooses to be required to perform any services after the tax year following the year of receipt of that advance payment. So, for example, flour company, an accrual basis calendar year taxpayer, sells its services under a 12-month, 24-month, and 36-month contracts. The company provides its services to each customer every month. On May 1st, 2016, Flour Company sold the following customer contracts. You had 12-month contracts with proceeds of $4,000, 24-month contracts with proceeds of $5,000, and 36-month contracts for $8,000. Now, how do we solve this problem? When must Flour include the income in 2016 or in 2017? That depends. It always depends for lawyers. It always does. So that red there is looking a little, look what you made me do, Taylor Swift style, but we're going to continue to work with this. So let's start with the 12-month contract. What of the $4,000 must be included for 2016? Well, if they choose to do this where they want partial income in 1 year when it's earned and partial income when it's earned for 2017, they can defer it based off of when they sold the contracts and how long the contract is going to be. So since they sold the contracts in May, for the $4,000, we would multiply that by how many additional months there would be for 2016, May, June, July, August, September, October, November, December. That would be 8 out of 12 months, giving rise to income of $2,667. So for 2017, the remainder for over 12 would then be 1,333 for the 12-month contracts. Now for the 24-month contracts, we do the same thing. We take the $5,000 that was collected on May 1st, and we multiply that by the remainder of the year, the 8 months from May, and divide that by the 24 months of the contract. That gives rise to $1,667 rounded for 2016, and for 2017 that gives rise to 16 months, the remainder out of 24. Now, and that is a total of $3,000. Now that's if that money is totally completed in the following month. Alright, now we take the 36 month contracts of $8,000. We know that there are only 8 months for the rest of the year, and we divide that by 36. That gives rise to $1,778, where the remainder must be included either in 2017 if it's completed then, or it would span several time periods, 6,222, when it is actually earned. Okay, so now let's talk about the hybrid method. The hybrid method is a combination of the accrual method and the cash method of accounting. It's generally used for inventory, when inventory is the income producing factor. income producing factor, meaning that that is how you actually make your income, is through your inventory, like Walmart. The taxpayer accounts for inventory using the accrual method and uses the cash method for all other types of income and expense items. So, for example, if you had inventory based off the fact that you are a hairstylist and you sell your inventory for all of your hair products, you then must use the accrual method for your inventory, your hair products, but for your services, such as doing hair, you then can use the cash method for your service and any interest income that you might incur. And the example just got too complicated. Okay, so this is primarily used for small businesses as well as contractors. So the inventory, which is the income producing factor, would be the houses that he sells, because he does he sells a lot of houses. That's his inventory. He can then use cash for all other expenses, such as remodeling, etc. Okay, so that is the deal when it comes to the different methods of accounting: the cash method, the accrual method, as well as the hybrid method. And we discussed when you have to actually include income and expenses on your tax return. And if you liked this episode, please give it a thumbs up and subscribe. And always feel free to leave a comment in the comment box below, as well as you can email me at centerfortaxstudies@gmail.com. Thanks so much for watching, and we'll catch you next time.